So we're actually going to start here with the federal funds rate. So what the federal funds rate here represents, this is the interest rate set by the central bank of the United States, the Federal Reserve, for short term debt. So what does that mean? Well, there's the government issues bonds, right, and banks issue loans to people, and there's a certain interest rate, which is the amount of extra money that you have to pay on top of your loan. So if you borrow a $100,000 from the government for 2 years, and they say they're going to give you an interest rate of 2%, then at the end of that time, you're expected to get $100,000 back plus your 2% interest. Right? That's the fee you get for lending out your cash. And the higher that interest rate is, the more that represents that the the person who's lending is trying to solicit people to borrow from them. They're offering a higher and higher price. Um, does that make sense? Let me say this in a different way. The If an interest rate is 0%, that means if I lend you money, I get all I get back is that money back. I don't make any profit on that money, right?
Mhm.
If interest rate is 5%, then um, uh, I'm incentivized to find people to lend money to because I want that extra 5%. If I just sitting here with my cash, that's not doing anything. That cash is not giving me any money. It's just sitting there. My $100,000 is just sitting there. But if I'm able to lend it out and get 5% back, well, my cash is working for me,
You're
right?
talking about from the bank's perspective.
Just in terms of interest rate, just in general, the idea of having an interest rate.
But let's say I have $100,000 and I'm loaning it out. Do I get interest rates? Like, how does
Well, I'm just saying, let's say it was just between you and I. If you
Oh,
wanted to
yes.
borrow $100,000 from me, then I'm going to charge you an interest rate
Gotcha.
because I'm risking my $100,000 that I'm giving to you, that I'm lending to you. I
Mhm.
expect to get that back and to be paid for the time that I didn't have that money,
Mhm.
right?
Gotcha. Yeah.
And so let's say there's two people, person A and person B. They each have $100,000, and person C wants to borrow, right? And person A and person B, they both have an expectation that this person's going to pay back this money, and so they want to lend that money out to that guy, right? Well, if I'm person A is offering 5%, what do you think person B might offer? A higher, equal, or lower interest rate?
Higher.
They offer a higher interest rate. They're trying to solicit it, right? But there's a limit to how high that interest rate will go, right? They might bid back and forth, but they're not going to offer a 200% interest rate, right?
Mhm.
And so there's a cap, there's a limit to where that'll go, and the interest rate settles around that price. And this interest rate exists for
Wait, the
any
person
type of
who's
lender.
borrowing wants the interest rate to be low, no?
The person who's borrowing wants the interest rate to be low, exactly, but they don't get to. It's a balance between. So the it's a negotiation, right? The person borrowing might say, 5% is too high. I'll How about 3%?" And then the lender might be like, "Well, 3% is too low. How about 4%?" And then you settle on the price.
Gotcha.
And so anytime and so you can imagine there's a pool of lenders and a pool of borrowers, and so there's a interest rate at which it gets settled at. That just as far as how market dynamics work, supply and demand works. Well, what happens is that the longer you lend your money out for, the more the more interest you want to earn, right? Because you have your money's out there longer. You're taking more risk that something might happen to that person, or they might not be able to pay it off, or what have you. And so, the further out in time that you lend your money for, the length of time that you lend your money for, also modifies the interest rate. Does that make sense?
Yes.
So, if I lend out money for 2 years, and I'm asking for 2% interest rate. If I lend it out for 5 years, I might ask for three. If I lend it out for 30 years, I might ask for five. And the difference there, there's a difference there for short term, medium term, and long term interest rates, right?
Yeah.
So generally, what financial institutions do that lend out money is that they will there's an interest rate being provided, long-term interest rates, usually in this case from the government. The government issues bonds, and they have bonds that go out to 30 years. Some countries have bonds that go out to 100 years. And so what the financial institution does is that they will buy long-term bonds, right? Because it's safe. In fact, the U.S. Treasury is considered the risk-free money that the government, everything will default before the government defaults on their bonds. And so they'll borrow out, get the high interest rate, and then when they're lending new money out at short term, 2 years, 5 years, what have you, they are uh, they're expecting a certain interest rate back, but they know there's a certain percentage of people who will default on the loan, who won't pay back that money. But there's a cushion between the money that they're going to get, the interest rate they're going to get from the long term uh, debt, the long term interest rate, and the
Mm.
short term. And so that buffer, the wider the spread is, the wider it is between the short term rates and the long term rates, the more risk the lender can take because there's more of a cushion there. Does that make sense?
Yeah, and so a bond is a loan that you're making to the government, if I'm not mistaken,
Exactly. In
and
this
the
case, it's
interest
government. It could also be the companies, but we'll talk about the government.
and interest rates are set by who?
So the interest rates are set by the market, right? In general. But short term interest rates, and this is where it gets interesting, are set by the central bank. Now, the central bank doesn't set the interest rate exactly, and then everyone has to follow that. But when the central bank sets an interest rate, they become one of the central bank is one of the players inside of the market, and so if they're setting uh, they're when they set the interest rate, the commercial banks tend to follow that. Well, actually, it happens the other way around. The banks. Let me put this in a different way because I don't want to get too deep in the weeds. What usually happens is that the central banks follow what the market says. So the market says, "Look, uh, we need to raise interest rates, right? Because people to solicit people to borrow from us, so we're raising interest rates, and so the central banks raise their interest rates to match." And then when the market says that no, we don't want to lend out more and interest rates come down, the central banks modify their interest rates to match that. There's all kinds of different reasons for that, but the central banks are responding to the supply and demand mechanics inside of the market. So the reason this matters is that the chart we're going to be looking at in a second is the interest rate set by the Federal Reserve for short-term loans, short-term bonds. And so you wanted to say something?
Yeah, I just want to be clear on one thing. When the interest rates go up, that's I thought that was to incentivize bankers to lend out money as opposed to incentivizing people to borrow money.
Well, there's two schools of thought that we won't really get into about that. Some people say that when interest rates go up, it means that financial conditions are tighter, which means there's not enough money moving around, and other people think that it's looser. What the Federal Reserve thinks is that, and the broader financial markets think, is that when they increase interest rates, that it reduces lending.
But isn't it more accurate to say not that higher interest rates incentivizes people to borrow, but higher interest rates incentivize bankers to loan?
Not exactly. That's why I didn't want to go too deep in the weeds because they are only the interest rate that is increasing is only modifying the short term, right? The long term rates are the Federal Reserve can't modify that. So let's say the long term rate is at 5%, right? And the short term rate for the moment is at 1%. There's a 4% spread between the short term and long term. So when the Federal Reserve increases their interest rate, the spread is actually getting smaller, right? And that's the cushion that the financial system needs in order to lend out. So what happens there is that it actually reduces lending. So the Federal Reserve increases
I
the
guess
interest
what
rate.
I hear what you're saying, Tom. It just sounds like you're talking that it incentivizes or de-incentivizes the banks to loan. It's not incentivizing people to borrow.
Well, no, the only when they cut interest rates does it increase,
That's right.
people's propensity, yeah, to spend or to borrow.
Gotcha. Gotcha. All right.
So the yeah. So we're gonna take a look here. We're gonna switch here to the historical chart of the federal funds rate. I only have it back to 1955 here. And so
Only.
you'll notice that we have this sort of ebb and flow. It's sort of like the sine curve that goes up and down and up and down and up and down. We won't really go into the details as to why um, the interest rate over here from 1955 to 1980 went up. That has to do with there was massive inflation in the 70s and 80s because of the baby boomer generation, the largest generation of children coming into the workforce, and so there was all kinds of different dynamics there that made it so prices went up. But what's interesting here is that since then, since the 1980s, the interest rate has only gone down, right? So these ebb and flows that we see here, these troughs and peaks, represent a cycle, which is what we're talking about when we're talking about the financial markets. We're looking at long-term trends and we're looking at cycles in the same way that you would look at weather patterns to figure out when it's a good time to plant or when it's a good time to harvest.
These
And
interest
so,
rates that are going down, is this short term or long term?
while the federal funds rate only affects the short-term rates, so this is the shorter term rate.
So this short term rate going down means there's a higher spread between the long term and the short term, which means it's an environment where money is
More
more
free
available.
flowing. Yes, more available, exactly. So in general, over this trend from 1980s till now, monetary policy has been in general loose. They've been putting more money into the system than they take out. It's this ebb and flow, this back and forth. But every time you'll, like we saw in the chart, it keeps getting lower and lower, lower highs and lower lows. It means that whenever the Federal Reserve started increasing interest rates in order to tighten conditions in the economy, and they never went as tight as it was in the previous high.
Hmm,
And when they cut to make financial conditions looser, it always went looser than it was in the previous low, all the way to the point
interesting.
that now we're at the zero interest rate.
My
So now they
goodness.
can't really cut anymore unless they go negative.
They'll never go negative, Tom. Never gonna happen.
So just remember here, when the line goes up, financial conditions are tighter, and when it goes down, financial conditions are getting looser.
What a chart technical way of putting that. Economic. There's more money flowing, less money flowing, tighter economic conditions. Is that the
Well,
way
I
you
want
think about the world now, Tom?
well, I don't want to use those terms because that's the term they use, and that's the terms you'll see in the
Yeah,
news articles and all that. So you got to know
I get it.
what they're saying up
Of
there. All
course,
right,
of course.
we don't want to be in a situation like I was when in high school.